This is kind of a long one I'll read here, and it's a topical, timely one. A big credit union in California had a ransomware attack, and there has been no access to customer accounts since June 29th. And I'm reading this post. This question is as of July 14th, so it's 2 weeks. Based on online comments, a good number of the credit union customers moved to a credit union because they distrusted big banks. After this incident, they're wondering if the benefit of being insured by the FDIC merits going back to a big bank because credit union insurance is NCUA. There's concern that may be a bank run when they do get up and running again. Then what? Question mark. Also, many are sharing strategies for not putting all your eggs in one basket when it comes to readily available cash, cash cushion, credit cards, mortgages, etc. These include having multiple bank or credit union accounts, using brokerage money markets to hold cash, having a credit card that is not from your bank credit union, holding loans that are not from your primary bank, etc. Great question / observation. A lot of things to unpack here. So, credit union is a bank-like thing. It's not technically a bank, but it looks and feels like a bank on the surface. The difference here is what they brought up. The main difference is that banks, at least banks that operate interstate, nationally, they have an insurance system called FDIC, Federal Deposit Insurance Corporation, where depositors are insured up to, I think it's $250,000 per account. Now, there's more to it, per owner, per account. Let's leave it at that for now. Credit unions generally aren't covered by FDIC. They're covered by a different insurance backstop called NCUA, which I think is for National Credit Union Association or something like that. Functionally the same. I don't know the fundedness level of the two different insurance systems. So maybe the credit union insurance system isn't as funded, so there's not as much protection ultimately if credit unions start falling like dominoes. But for the most part, I think the two are comparable. You don't have to worry about the level of insurance at either, is my understanding. I could be wrong. I never thoroughly researched credit unions, but my understanding is don't let the underlying insurance, deposit insurance thing stop you. They're more or less comparable, I believe. The bigger question here is the person that I heard of, they had most or all their financial accounts, bank accounts in this credit union. The credit union had a massive ransomware attack and basically shut down all access to the system. People could not get money out of the bank and still can't apparently 2 weeks later. So not only can you not log in online, you can't transfer money out. Like if you have online banking, you can't pay bills. If you want to transfer money out to your other bank account that you had at a different bank, you can't do it. So that's scary. You're kind of shut down financially, at least with all your money there. So the broader question is should you diversify the number of banks you have accounts and access to and with? So if and when one of them does get hacked or has a malfunction in online services, or you can't get your money for whatever reason, you have another one to go to. I think on the surface that makes sense. Case in point here, if people that had all their money at this particular credit union in California also had another bank account somewhere, then yeah, they get shut out from the credit union temporarily, weeks, but they have access. They can quickly go about banking there. Problem is, unless you already have enough money in both places, if you just have $200 in your backup bank account, right, just so you have connectivity to a bank, and you have your tens of thousands of dollars in your credit union that's locked up and locked down, well, it's not going to do you very good to have a few $100 in this other one you can access, because that's not going to get you through daily bills for a few weeks, right? So if you truly want to diversify and have access to other banks, in case one gets shut down for whatever reason, you basically need to function in parallel. You need to have online bill pay set up with the other one. You need to have decent enough size money in the other one so you can actually live off it for potentially a few weeks or more while the other bank is shut down. So I can't say it's a bad idea to have access to multiple banks, but unless you really think through it and have it truly set up and more or less run in parallel already, it'll probably be of limited value to have a second bank just kicking around without much in it in this scenario. But again, it can't hurt. Other bigger picture thing, diversifying not just banks and cash, but other banking products, loans, credit cards are issued by banks, mortgages. Yeah, I guess in theory, same reasons, right? Diversify your exposure to institutions by having your mortgage at Bank A, your checking account at Bank B, your savings account at Bank C, your credit cards issued by Bank D or whatever. Now, there are some benefits to having stuff under one umbrella, one institution. They may cut you deals. Going back to, I mentioned this in previous episodes, but if you work at one of the household name banks that are also associated with the brokerage firm, they often cross-sell you on things. So it's hey, You have a brokerage account with our brokerage firm. Why not open a bank account with our banking firm? If you do that, we'll waive the maintenance fees for that. Or get a mortgage through our bank arm, and we'll give you a favorable reduced rate compared to what you get if you were just some straggler off the street getting a mortgage. So there could be benefits to having most or all of your banking activity at one institution for that reason: efficiency and or lower fees, lower costs, and just day-to-day efficiency with like one website you can monitor and log into all this stuff. But the downside being concentration in that website now, like the example with this California credit union. So yeah, I have mixed thoughts. I definitely can't knock the idea of diversifying exposure across financial institutions. I don't know that it's necessary. Now, if and when something really bad happens, like this California credit union where people are locked out of and can't get money, then obviously it's like, yeah, of course it'd be better to have had a second account. But is it worth what it's going to take to properly set up and maintain and fund and have connectivity to that second account for the if it ever happens? I don't know. That's for you to decide. There's value in simplicity and streamlining. That's one of my big mantras in what I do personally and professionally. But I do fully acknowledge that there could be risks if you have concentrated exposure to certain institutions. So do with this as you please. I'm not personally that concerned that I feel the need to myself go out and have fully established banking relationships across multiple firms in case my primary bank organization gets their website locked down or something. But this is interesting food for thought that this person raised. So great question. Thank you.